The spring market isn't March and April. The spring market starts now.
Welcome back to this week's episode of Change in the Market. I'm your host today, Kevin Shamala, and with us is the Executive Chairman of the Masiello Group, noted industry luminary, and best-selling author, Chris Masiello. Thanks for joining us today.
Hi, Kevin. Good to be with you. Good to be with everybody in our community, as always.
I know, and we're already into February. When does time fly? And so with that, I think a great way to kick off this conversation is to start off with recent forecasting changes that we've seen from some of these industry journalists or industry outlets push out. Recently, I saw that Zillow changed their forecasting. Previously, it was a slight decrease in housing prices by, I think, less than 1%. Now they've updated their forecasting to show that there's potentially going to be house prices increasing up to 3.5%. And so I just wanted to get your take on why we're seeing quite a few discrepancies over these last 2 years, right, leading up to now, and why these forecasting are changing so quickly.
Well, people are confused. Sorry to be some flip about it.
Yeah.
I mean, look, we've talked about this a lot, right? That, and Peyton and I covered it a little bit last week. Is that we're truly dealing with all new market dynamics, right? So in a traditional sense, yes, when interest rates go up, prices tend to either be flat or go down because your cost of borrowing goes up. But we don't really have those specific dynamics or corollaries anymore. And so pretty much everybody, the major prognosticators in the industry have made corrections to their forecasts because it's actually not panning out that way. And so, so you take a traditional forecast model, and then because that's what you're used to using, and you apply that to an environment. And what they're doing is they're taking a traditional forecasting model and applying it to a new environment where that forecasting model, doesn't really match the dynamics. That's what you got. So I think it's, maybe I was a little too quick to say confused, but in short, it's trial and error. So I'm not surprised by that, really. I'm not really surprised by that.
Yeah. Do you think that updated forecast correlates any way into the potential recent predictions of rates floating down in the near future?
Yeah, I mean, the interest rate environment is kind of multi-layered. So interest rates went up pretty quickly. They skyrocketed up, but they will, as you just said, they will float down. They won't come down that quickly. I think just for monetary policy, they'll be pretty conservative about how and when they reduce rates. I don't think it won't go down the same way it went up. I think what that does, though, is that as rates start to go down, and again, as we've talked about, it's kind of in that mid-5 range. Once we're consistently in that mid-5 range, I think that's going to unfreeze the market, so to speak. Right now, you've got, which this is kind of a phenomenal number, and I've heard this a number of times, so it feels accurate to me. 90% of all mortgages that are in force right now are 4% or below. So, 4% to 7% doesn't feel very good. 4% to 5.5%, man. Okay, fine.
Yeah, absolutely.
And so, or maybe 6, depending what your needs are. And I think that will serve to unfreeze the market where there are people who want to make a move, need to make a move, for reasons, families are expanding or, whatever the case may be, right? And they need to make a move, and they're just kind of waiting, for the cost of borrow to go down. And now that could also include people who are downsizing too, because once the market unfreezes, what's going to really impact it is going to be more inventory, right? Because typically people are going to sell things to buy things, and to sell it, they got to put it on the market. So that's what's going to unfreeze. That's what's going to unfreeze the market.
Yeah, no, definitely. And I think to your point too about those who are downsizing, I've recently seen articles about the reason why it's held out thus far, right? And that's just based on the math of their downsizing and then the cost of borrowing, right? Didn't make sense maybe a year ago or 2 years ago. But I think with the changing of the dynamics of the market, that might help to unlock some of those who want to downsize and help improve our supply, right, and our inventory.
It's now, right? We're into February.
Yeah,
I know it's still cold, right? I got a vest, a long sleeve shirt on, so it's still cold, right? But I mean, the reality of it is that this is the spring market. The spring market isn't March and April. The spring market starts now, because you get your house on the market. It's going to take you, somewhere between 30 to 60 days to sell it. It could be less, of course, right? But just to say 30 to 60 days, or 30 to 60 days from now is April 1st. And so when you think about it, this really is when the traditional spring market starts. And I myself and many others, right, who provide financial advice, are all of the same mindset that yes, your borrowing costs are higher now. However, if you can sustain the borrowing costs for a short period of time, now's the time to get into the market, because once rates go down, there'll be more inventory, but there'll be more buyers, there'll be more competition, and prices will go up more aggressively. And I think that's what you're seeing in that revision by a number of different industry prognosticators. Everyone's revising their estimates to go up. Yeah. And so I think that's really reflective of what's about ready to happen.
No, absolutely. And yeah, it's the spring market is now. So I envision, as we consistently talk about, right, if you're waiting for that trend to happen, you're going to be too late. So I think for those looking to take advantage of the market, we've said it before, it was a great time then. I think it's an even better time now, before we see those dynamics change, and some for the better and sometimes for the worse, right? Depending on where you're at in the market.
Yeah, I mean, you're really leaning into, we had to lean into increasing rates. Now we're going to be leaning into decreasing rates, and it's going to have an entirely different dynamic than the market's ever seen before. But a few things we know that, we're still short on inventory. That's not changing anytime soon. And at the same time, that's what's helping sales prices stay buoyant. So it's not bad.
Right.
And even as we start to introduce new housing starts, they won't be introduced at such a rate that it'll upend the market, because there's a lot of demand still that needs to be soaked up. So I think there's this thing about, and maybe we can kind of end with this, right? I think there's this kind of mindset about, well, like, how much information do I need before I move into action? and I think at this point, if you're kind of on the fence, and I'm not quite sure if you're going to get any better information, either from something like this or certainly many other places like the articles you referenced. Everyone's kind of saying the same thing. I whether it's at work or personal or whatever, right? I kind of have this philosophy of well, if not now, when?
Yep. No, absolutely.
Right? So kind of like, if not now, like when? Like, exactly. What are you waiting for? Everything you need to know right now,
Yeah, there's no hidden secret out there, right, that people are holding close to the chest. I love this is the market we have, and there's that old phrase, get in where you fit in, right? There's opportunities virtually for almost whoever that theoretically get qualifies to be in the market. So I couldn't agree more.
So folks, we'll just end with this, right? So if not now, when?
Yeah, that's perfect. And thank you again for tuning in and listening to another episode of Change in the Market. Please like, subscribe, share with your friends and family. And as always, we appreciate your time, Chris. Thank you. And we'll see everybody next week.
Yeah, take care. See you next week.